Good morning, everyone, and thank you for choosing Market Briefing, market analysis, and financial news. Every day, our goal is to provide you with a thorough and knowledgeable analysis of the most relevant financial news to help you navigate the complex economic landscape. Let's begin our daily review. Market analysis, October 30, 2023. European and U.S. stocks pushed higher Monday as the conflict between Israel and Gaza eased over the weekend. The Pan-European Stoxx 600 index rose 0.7%, rebounding after hitting a 10-month low last week. S&P 500 futures also gained around 0.7% in early trading. The limited Israeli military strikes on Gaza have relieved fears of a major escalation in violence, reducing demand for safe haven assets. Oil prices fell back below $90 per barrel, while gold dipped under $2,000 an ounce. The Israeli shekel currency, which lost significant ground this month, clawed back 0.4% against the dollar. Markets remain on edge, however, ahead of several potentially market-moving central bank meetings this week. The U.S. Federal Reserve, Bank of Japan, and Bank of England are all set to announce interest rate decisions. The Fed's Wednesday policy announcement will be closely watched for signals about future rate hikes, as markets weigh recession risks. While geopolitical tensions often spur demand for U.S. Treasuries, yields have remained elevated even amid the Israel-Gaza conflict. The 10-year Treasury yield inched higher Monday to around 4.86%. Investors are focused on Wednesday's U.S. Treasury Department quarterly refunding announcement, which will detail government bond supply and borrowing estimates. The Treasury plan could end up overshadowing the Fed's rate decision in terms of market impact. Massive bond issuance is needed to fund widening U.S. budget deficits, but could also put significant upward pressure on already high yields. Stocks are recovering from a dismal October thus far, which has erased over $12 trillion in value from global equity markets since late July. Central banks' aggressive rate hikes to combat inflation have stoked concerns of a potential global recession. The Fed has signaled rates will likely remain higher for longer, even as policymakers say they are nearing the end of this hiking cycle. In corporate news, shares of major European bank HSBC Holdings were little changed after quarterly profits fell short of expectations. HSBC did announce an additional $3 billion share buyback program, helping offset the earnings miss. Earlier in Asia, Chinese tech stocks jumped after President Xi Jinping's new leadership team raised hopes that a bruising regulatory crackdown on the sector could ease. The Hang Seng Tech Index surged over 9% at one point before pairing gains to close up around 3%. Japan's Nikkei finished 0.7% higher, while the Shanghai Composite closed flat. This week's economic data calendar includes U.S. GDP figures for the third quarter and the September Personal Consumption Expenditures Price Index, the Fed's preferred inflation gauge. But the Fed's outlook and Treasury's borrowing plans may end up driving markets. If bonds sell off on fears of heavy issuance, stocks could come under more pressure. Oil declines as Gaza tensions ease. Oil prices fell back from two-week highs on Monday, dropping below $90 per barrel again. While Brent crude remains up over 6% in October, it has eased in recent days as the Gaza conflict cools. Energy traders have been closely monitoring the violence for any potential impacts on Middle East crude supplies. Regional tensions often add a geopolitical risk premium to oil. But Brent's retreat from over $92 last week signals the Israeli-Gaza clashes are not expected to significantly disrupt output or exports. Still, upside risks remain for oil as the EU nears a ban on Russian seaborne crude imports starting in December. The loss of Russia's crude from global markets should tighten supply further. OPEC Plus also may opt to cut production quotas at its November meeting to prop up prices. Natural gas prices are also retreating somewhat in Europe, dipping back under €100 per megawatt hour after spiking last week. While still sharply higher year over year, gas prices have eased since August's record highs. Unusually warm October weather and efforts to fill winter storage have helped take pressure off extremely tight European gas markets. Gold slips as haven demand slows. Gold edged lower on Monday, falling below $2,000 an ounce after jumping over 6% at one point last week to $1,970. Heightened market turmoil often boosts gold's safe haven appeal, but prices are giving back some gains as stocks rebound. Rising interest rates have weighed heavily on non-yielding gold this year, with prices down around 10% year to date. Gold is highly sensitive to the opportunity cost of holding it versus other assets. But stubbornly high inflation has offered some support, keeping gold up as a store of value. Global bond yields retreating from recent multi-year highs has also removed some downward pressure from gold prices. If the Fed signals an even more gradual hiking path or earlier pause, it could provide a further lift to gold by reducing yields. Analysts say gold may be range-bound near $2,000 in the short run until markets get more clarity on central bank policies. But major technical resistance doesn't appear until near the $2,100 level. While no longer surging higher, gold seems to have found its footing above $1,900 an ounce for now. Before proceeding with our analysis, we would like to remind you that your support is very important to us. If you enjoy this video and find our content helpful and engaging, please consider giving it a thumbs up and subscribing to our channel. This helps us grow and provide you with even more quality content. Now, let's get back to the news on the financial markets and the latest updates. Bitcoin has held steady above $34,000 to start the week, up around 1% over the last 24 hours. The overall crypto market is showing signs of strength as well, with the CoinDesk Market Index gaining 1.1% Monday morning. Crypto investors seem optimistic ahead of the U.S. Federal Reserve's big policy announcement on interest rates this Wednesday. While the Fed is expected to pause rate hikes for now, any hints at future policy shifts will be closely watched. A neutral Fed outlook could signal growing mainstream acceptance of digital assets as the crypto winter continues to thaw. In a sign of crypto's momentum, the Chicago Mercantile Exchange, CME, has overtaken Binance as the second largest Bitcoin futures exchange. CME saw open interest in its BTC futures contracts top 100,000 for the first time ever, with its overall market share hitting a record 25%. The rise of CME, a mainstream regulated exchange, points to growing institutional participation in crypto's recent rally. Thailand's Kasikornbank, K-Bank, revealed another major bank foray into crypto Monday, acquiring a 97% stake in domestic exchange Satang. The $102 million deal will see Satang rebranded as Orbix, with K-Bank launching several crypto subsidiaries. Rival Siam Commercial Bank also inked a partnership last month with leading Thai crypto investor Hashed. Major Thai banks are rapidly positioning themselves to capitalize on surging local demand for digital assets. According to data from Into the Block, the number of Bitcoin transactions worth over $100,000 hit 23,400 last week, the highest level so far this year. The spike in large individual transfers suggests Bitcoin whales were active participants in pushing BTC above $35,000. While retail volume has also picked up, the rise in institutional activity could signal smooth sailing for Bitcoin as it gears up for its next halving in April 2023. Historically, reward halvings have preceded massive bull runs. Today's crypto gains build on an extremely strong week across global markets last week. Stocks rallied Friday despite hotter than expected U.S. inflation data for September. The S&P 500 actually rose over 2% on the week, while the tech-heavy Nasdaq jumped nearly 4%. The Dow gained over 5% for its best week since June, recovering from a steep sell-off the prior week. Driving last week's risk-on shift were stabilizing bond yields and growing belief the Fed may slow its aggressive pace of rate hikes. Markets are now pricing in a 75 basis point hike in November, down from predictions of a full percentage point increase after September's hot inflation print. While recession fears linger, hopes of a Fed pivot have eased worries of a hard landing. With major banks set to kick off earnings season later this week, stocks appear poised to add to last week's monster gains. However, all eyes remain squarely on the Fed's rate decision Wednesday afternoon. Markets expect a 75 basis point hike, but any dovish signals could supercharge the ongoing risk asset rally. If the crypto surge withstands reduced hawkishness, it would underscore growing institutional inflows and cement digital assets as an inflation hedge. In conclusion, we'd like to thank you for watching Market Briefing, market analysis, and financial news. If you enjoyed our insights and found the information helpful, please consider leaving a like and subscribing to our channel to stay updated with future analyses. Thank you again for your support, and we'll see you soon with more interesting news. Remember, the information in this video is purely informational and does not constitute investment advice. Always consult with a professional before making financial decisions.